Where are housing prices headed between now and the middle of 2022? And what's Joe Biden doing to impact the housing market now? We're going to discuss that. Hi, I'm Keith Weinhold. This is Get Rich Education. Yes, Joe Biden extends the eviction and foreclosure moratorium yet again until the end of this month. This headline here that you say from Housing Wire shows quite a bit of optimism that it is indeed going to be for the last time. A lot of experts say this is it. It won't be extended again. I don't know. On our LinkedIn and Instagram polls here at Get Rich Education, the vast majority say no, it won't be the last time. Maybe they're just being a little bit cynical. I don't know. But that should expire at the end of the month. Now, more interestingly, and kind of somewhat off the radar, are what Biden seems to be giving some sort of approval to are the potential formation of 40-year term mortgage loans. Housing Wire again tells us that Ginnie Mae is allowing lenders to securitize modified home loans with terms up to 40 years as the Biden administration works to make more housing options available for struggling borrowers. This new pool type will allow Ginnie users to offer loan modifications that carry a lower payment than a 30-year mortgage while retaining the ability to securitize the loans into the secondary market. Okay, so Ginnie expects the new pools to be ready for use by October, but their extended term modifications, they would still have to be authorized by the FHA and other agencies. So in short, this could be something that we begin to see later this year, a 40-year mortgage offered, not just a 30. So this does help make homes more affordable for buyers. It creates more bidders for homes, therefore, if more people can afford it. It drives up prices, so it helps buyers. It really helps the demand side. Again, we need help on the supply side, not the demand side. If we're going to house people, we need more housing supply. So although that's not going to help as many people out when we increase demand rather than increasing supply, you do have to understand that what this does then, if someone were to get into a 40-year loan rather than a 30-year loan, is of course it makes for lower monthly payments. You're stretching that payback period over 4 decades rather than 3. And for a real estate investor, just say that these did become available at some point for investment property, for income property. It's going to create more cash flow on those properties. But even if you're using a 40-year loan versus a 30-year loan on a primary residence, of course, it's going to create more personal cash flow for you because it's going to keep your payment down. And I would expect with 40s, I would predict that 40-year mortgage loans would have a higher interest rate than 30-year mortgage loans would, just like 30-year mortgage loans have a higher interest rate than a 15-year mortgage loan. And intuitively, that just makes sense. In fact, let me ask you, if you were going to loan money to someone for 15 years or 30 years, where do you feel like you would need to be compensated with a higher interest rate for a payback? Well, if you're not going to be paid back for 30 years, there's more risk there. What if something happens to your borrower? What if they die? So you need to compensate for that risk by having a higher interest rate because you're loaning out your money longer. If you're loaning it out for 30 years rather than 15, just like with 40s, it would be even longer. So the bank would probably need to get a higher interest rate to compensate for that greater level of risk. Now, I think the old-fashioned mindset might be critical of a 40-year loan. They would try to substantiate that with, oh, well, you're going to pay more in interest over the life of the loan because it's going to take you longer to pay that loan off. Well, the paltry interest rate savings are typically trumped by what you could do with those dollars if you're not spending the extra money paying down a loan. When it lowers your payment, you can take the difference, that extra cash you have in your pocket, and invest it so that you could beat today's low mortgage interest rates. That's often what's not seen when you look at loan amortization tables. It lowers your payment so that you could increase your cash flow with a 40-year loan, and you now have more dollars borrowed cheaply where you can invest that elsewhere for a higher return. In fact, consider that, okay, if it doesn't make sense to pay down principal, therefore making a 40-year loan more efficient for you over the long term than a 30-year loan, then wouldn't it make sense to not make any principal payment at all and only make your interest payment if you could? Yes, in most cases it would. And do you know something? Interest-only loans are actually my favorite loan types. Now, they're not available. They were pretty widely available, back 15 or more years ago, before the global financial crisis. I actually had an interest-only loan. It really increased my cash flow because I did not need to make any principal payment. But oftentimes with interest-only loans, you have the option of making a principal payment if you want to. Now, I did have to pay a 0.25% higher interest rate versus a 30 with the interest-only flexibility that I had like that. But again, if I'm making a principal payment, I'm converting cash flow into equity. Financial freedom is achieved by doing the opposite, converting equity into cash flow, hence the attraction to the interest-only loan. Now, interest-only loans got a bad name leading up to the global financial crisis because a lot of people bought homes with teaser rates, and the only way they could afford it is if they got an interest-only loan. So they got a bad name for the wrong reason about 15 or more years ago. Remember, some people would say, well, wait, then your principal's never getting paid down. How would it ever get paid off? It typically doesn't make a lot of sense to pay off a property, although there are some special circumstances in which you would want to pay off a property, but you typically don't. And you've got to keep in mind that inflation debases your principal. Say you'd have a $300,000 mortgage loan. You don't pay down any principal all year, but we have 3% inflation. Now, after just that first year, you only owe the bank back $291K in inflation-adjusted terms because inflation debased $9K of your mortgage principal on a $300,000 loan at a 3% inflation rate. Now, something else called negative amortization loans became popular leading up to the global financial crisis. You can't get those anymore. That's where you didn't have to pay down any interest at all, and your mortgage principal actually increased month after month. A negatively amortizing loan. I don't expect them to be available again anytime soon. Hey, put a YouTube like on this video if you're getting good value out of it. Hey, maybe you like the idea of an interest-only loan a little bit more than you thought once you wrap your head around it somewhat. So I'd really appreciate the YouTube like. That tells YouTube it's a good video, and it also helps material like this occur in your feed. Now, the research staff over at Zillow recently gave us both some interesting data and some really good predictions with what they see coming for the housing market. So if we look at this piece from Zillow, some of the highlights are that they let us know that rent growth has now been the highest since 2015. So first you had property prices run up, and now you have rents increasing, trying to keep up proportionally to home prices. In every cycle, they typically lag. Rent increases are highest in the inland west, even 15% year over year. In a lot of these Intermountain West cities. Home appreciation broke new records like I've been talking about in other videos. And check out the typical time on the market, the typical time that a house sits on the market before it's under contract to sell. Now, as you know, in the real estate world, 5 to 6 months of inventory is seen as a balanced market. If there's more inventory than that 5 or 6 months, that puts sellers at a disadvantage. That's called a buyer's market. And if there's less than 5 to 6 months of inventory, that puts the sellers at an advantage, called the seller's market. Recently, you saw us dip down below 3 months nationally, even below 2 months in a lot of markets, even less than 1 month in a lot of markets with this chronic undersupply. Zillow reports that the typical time on the market now nationwide has fallen to just 6 days. 1, 2, 3, 4, 5, 6. 6 days. Just astounding with the rate that these homes are flying off the market. And the typical time on the market they found is shortest in some of the hot Midwest metros like Cincinnati, Columbus, and Kansas City. In fact, as little as 3 days. You can go directly to our preferred income property provider at getricheducation.com/Cincinnati. If you're pre-approved for a loan and you're looking for an income property where the numbers make sense and you have a renovated property with a tenant already in it, and you have the option of having that company manage it for you as well, you can get pre-approved for a mortgage first. You want to do that first, and then check out the properties through getricheducation.com/Cincinnati. Zillow does not expect home appreciation to subside anytime soon. In fact, Zillow economists expect, get this, home values to increase 6.1% over the next quarter nationally. Over the next 90 days, 6.1% appreciation. And that's about the long-term average real estate appreciation rate across the United States, 6%. We're talking just the next quarter. They divvied up the quarter between May and August. You're going to expect that much home appreciation. And by 17.9% through the end of this year. So that would be December 2020 to December 2021. Basically 18% appreciation expected between those months, which is just remarkable. If you put a 20% down payment on a property and you have an 80% loan on that property, you therefore have a 90% rate of appreciation on your down payment because you take the 18% appreciation and multiply it by 5. It's by 5 because you only put 1/5 of the property value into that down payment. Yeah, you're benefiting from that power of leverage. So expect more appreciation. If we look at a later period, if we take the 12-month period, which Zillow did from May of 2021 to May of 2022, really getting toward the midpoint of next year now, they anticipate that appreciation rate to be 14.9%, basically 15%. So we'd see some slowing appreciation, which I've got to expect sometime because at some point we need to hit an affordability constraint. So homes still appreciating at a pretty torrid pace, but perhaps just not the pace that they had been previously. More appreciation driven by this low supply, fueled by low interest rates and high demand. You know, when you've got a low supply of something, you have really one of the two huge elements in what makes anything in the world valuable: scarcity and utility. The utility or the use of a home while it's scarce, continuing to drive these prices. And you know, homeowners can afford a home during this torrid price run-up, which is substantially different than what we saw in 2006 and 2007 with the global financial crisis. I have been through two big housing run-ups and two major recessions. I've been directly investing in real estate myself since 2002, and some of the other elements that make this recession different from the prior recession are the fact that, you know, back around 2005, you had low wage earners that also had low credit scores that were still able to qualify for a home because qualification requirements were nearly non-existent back in 2005. That's in the opposite place today. Here in 2021, 2022, we have high earners that have high credit scores. In fact, the average credit score of a mortgage borrower during the second half of last year was 786. You know, we talk about inflation a lot here, but that's really credit score inflation, if you want to call it that. Really high credit scores for today's credit-worthy borrowers. And the other really huge difference between this recession and the prior one, this housing price run-up in the prior one, is the fact that homeowners have a lot of equity in their properties. In fact, CoreLogic tells us that the average homeowner borrower has about $200,000 in equity. So people are incentivized to not walk away from their home like they were about 15 years ago when they had essentially zero equity in it. There wasn't anything to walk away from. And 15 years ago, they didn't have any good credit to protect, to keep intact either. So they had every reason to walk away, well, they have almost none to do that now. And there is some rigidity to these stricter loan requirements. The 2010 Dodd-Frank Act imposed stricter loan requirements. So that has an awful lot to do with this, the lending requirement, the responsibility of that borrower homeowner. And I'm going to say something that maybe if you're not quite initiated on this, you're going to think sounds a little absurd. Homes are actually somewhat affordable. Yeah, even today, even with this great run-up in the median home price here where we are in the second half of 2021. In fact, take a look at First American's Real House Price Index. This tracks real home prices. I'll tell you what that means in a moment. They are still substantially lower than they were in January of 2020. and even lower than that compared to the 2006 peak. So what's done with this first American Real House Price Index is, they basically help reinforce the notion that I've been talking to you about for a while, that most people buy a home not based on the price, but based on the payment. Of course, the payment is lower because of low mortgage interest rates. You can't just look at the capital price of the house and not adjust the capital price of the house itself for inflation. So you got to look at the inflation adjusted price over the long term. We've had a lot of inflation over the last 15 years since the last run up, if you make it cumulative each of those 15 years. And then people have higher wages. That's also resultant of cumulative inflation, as moderate as it might have been over the past 15 years. So that's what the Real House Price Index represents. And most experts agree that the low housing supply that we have is something where it's going to take us at least a decade of home building in order to get back out of it. So although home price increases have got to slow down sometime, probably by next year, yeah, they are expected to continue. Investment property has made more ordinary people wealthy than anything else because, as I like to say, you are paid up to 5 ways simultaneously. GREturnkey.com is where we have the providers where I do my own buying of investment property out of state, where I expect to have all 5 of those profit centers. That's where those property providers are. You do want to get pre-approved for a mortgage first, and then check out some of those providers that seem interesting to you, including the Cincinnati one that I mentioned there at GREturnkey.com. I'm Keith Weinhold. Thanks so much for being here. You weren't here for me. You were here for you. I'll see you in the next video.